Now we assess the valuation of Nestle. As on 31st December 2007, the value of Nestle is 195,661 million Swiss francs. However, it has significant investment into other companies, that is Alcan and L'Oreal, and they respectively account for 36,499 and 28,961 million Swiss franc in market value. So the market value of Nestle only operations is 130,201 million Swiss franc. The total earnings of Nestle are 10,649 million Swiss francs. However, a breakup of this is given, so we have earnings that are attributable to Alcon, L'Oreal, and Nestle's operations only. The respective price-earning ratios for each of these have been also calculated and given here. So we see that Nestle's operations have a price-earning ratio of 16.3, which is significantly lower than compared to Alcan and L'Oreal. Based on our financial analysis of Nestle that we have done so far, we have assessed that Nestle has sufficient cash flows and has actually reduced its leverage over time, so this risk discount may be inappropriate. Overall, we can conclude based on the analysis here that Nestle may be undervalued. Note that the Nestle's market capitalization of its operations is 66.5% of its total market value. However, its earning contribution is 75% of the total earnings of the firm. The second case study relates to applying the framework of financial analysis to evaluating the off-balance sheet leverage in the form of operating leases. We will be calculating the present value of the operating leases and adding it to the assets as well as total debt of the company, and then calculating the different leverage ratios. The expected lease payments are given here for the year 2008, 2009 till year 2016. We have calculated the present value of each lease payment expected in year 2008 till 2016 and have summed them up. So the present value of all the future operating lease payments is 1075 million. We have used 4.3% here as the effective cost of debt of this company to discount the respective operating lease payment in each year. The sum of the present value of the operating lease payments will then be added to total assets as well as to total debt. These will then be used to calculate different leverage ratios. Remember that we already know that capital or finance lease is reported on the balance sheet both as an asset and as a liability. However, the operating lease is not reported on the balance sheet. So therefore, as we discussed earlier, we will have to add the present value of the operating lease payments to be included in the total assets as well as in the total liabilities. This is expected to increase the financial leverage of the firm and at the same time decrease interest coverage ratios. Here we have the financial leverage and debt to equity as well as debt to long-term capital ratios calculated based on the reported numbers in financial statements as well as based on the numbers that have been adjusted for the present value of operating leases. So we can see that financial leverage is 5.5 times when based on the reported numbers in financial statements. However, when we add back the present value operating leases to total assets, the financial leverage increases to nearly 6. Debt to equity ratio more than doubles when the same is done, that is when we add the present value of operating leases to long-term debt. Similarly, the debt to long-term capital ratio also increases significantly after we add back the present value of the operating leases to long-term debt and long-term capital. Note that after year 2019, you do not have to adjust for operating leases anymore, as the new financial reporting standards such as IFRS by International Accounting Standard Board now requires that leases, whether operating or financing, should be capitalized and shown both as part of assets and part of long-term debt on the balance sheet of companies. In the third case study, we evaluate the effect of changes in accounting standards using the framework of financial analysis. Please note that the standards have changed now, and it is highly unlikely that a qualified special purpose entity, which is a paper-based company, may not be consolidated. So in most of the cases, now financial accounting standards require the QSPE, that is qualified special purpose entity, to be consolidated. Previously, accounting standards allowed companies, particularly financial institutions, to remove assets from their balance sheet. The combination of asset removal along with non-recognition of liabilities significantly affected the financial leverage of the company. Subsequently, there have been changes in accounting standards that require companies to consolidate qualified special purpose entities into their balance sheet. We look at such an example in 2009 when companies were expected to change their reporting for qualified special purpose entities. Let's have a look at it. The company Software Services has sold $267.5 million of finance receivables to a special purpose entity. The company's abbreviated balance sheet is given below. Total current assets are 1.4 million. Total assets are 3.6 million. Total current liabilities are 1.27 million. Total liabilities are 2.63 million, and total equity is 0.97 million. To see how the changes in accounting standards will affect the financial leverage of the company, we calculate the financial leverage assuming there is no change in accounting standards as previously, and assume that the receivables have been sold and are not included in assets and liabilities. In this case, we will have the total assets equal to this amount, and we divide it by the total equity, and the financial leverage is 3.7. Now, if we assume that the accounting standards have changed and we must record the receivables sold into the assets of the company, and will also have to create liabilities on the balance sheet. Of course, we don't need liabilities in calculation of financial leverage. However, keep in mind that it will be added to financial liabilities also. So in that case, the total assets will now include the receivables that have been sold as an asset, and we will divide it by total equity, and this will increase the financial leverage from 3.7 before the new standards or the new accounting rules have been introduced to 3.97. Therefore, we can conclude that the accounting changes here have resulted in increasing the financial leverage of the firm. However, such an adjustment for qualified special purpose entities is no more needed, given that the accounting standards have already changed since 2010.